Então eu quero agradecer ao Bradesco. O Bradesco hoje ele tem um programa de inovação aberta, que ele é pioneiro, que é o InovaBra. Ele foi criado para apoiar projetos arrojados em startups com soluções aplicáveis ou adaptáveis ao setor financeiro. Quero agradecer muito a Derrac Menezes. A Derrac é um escritório com ampla atuação e ênfase em dinheiro empresarial, que combina experiência local e visão global. O Pedro está aqui, Ferreira, e também a Camila, se alguém quiser falar com eles. Cadê o Pedro? Cadê a Camila? O Pedro vocês conheceram, já falaram. Queria agradecer muito a Grant Thornton. A Grant Thornton é a quinta maior empresa no ramo de auditoria, consultoria e outsourcing no Brasil e nas principais economias do mundo. Alguém tinha me falado como entrar em contato, o Paulo Funchal está por aqui ainda, eu acho, é só procurá-lo. Quero agradecer à Microsoft. A Microsoft é uma empresa de tecnologia que, através do BISPARC, incentiva o desenvolvimento de jovens empresas de tecnologia, ao oferecer a ela recursos essenciais para o seu crescimento. Quero agradecer à R.R. Donnelly, que tem mais de 150 anos de experiência em serviços às transações corporativas e hoje oferece plataformas seguras para colaboração e armazenamento de documentos em nuvem. A Carlos Nogueira está aqui também, se alguém quiser falar com ele. Cadê o Carlos? Esse povo desaparece, né, quando eu o cito. Quero agradecer também a Matrix. A Matrix é o único data center Tier 3 Carrier Neutral em São Paulo e a gente está aqui com o Rodrigo Oliveira, se alguém quiser falar com eles. Agradeço também muito ao Centro de Empreendedorismo da GV, que nos recebe hoje aqui, em especial pelo professor Thales Andreassi e pela Aline, e ao apoio institucional da Apex Brasil, que é a Agência Brasileira de Promoção às Exportações e Investimentos. Eles têm, inclusive, um escritório em São Francisco, a gente tem falado bastante do Vale. Então, se alguém precisar de conexões lá, é só procurar o Jaime ou procurar o próprio pessoal lá de São Francisco. Eles fazem um trabalho muito bacana lá. E ao Scala, que é uma iniciativa do BID Fomin e do IEM, que é uma plataforma para apoiar o crescimento de redes de investidores anjos na América Latina e no Caribe. Então, feito os agradecimentos muito honestos e muito sinceros, I will switch to English again. This is our second talk from person from Silicon Valley, so I want to invite Mike Hennessey to come here. Where is Mike? Here you are. We met Mike 2 years ago when we come to a delegation from Brazilian angel investors to the Valley, and I really like the way that Mike received us and how direct he was, how he can put the things. So I'm sure you are going to enjoy his talk very much, and he can say more about himself, about PuenteLabs now. Okay? Thank you, Mike, so much for being here.
Thanks for having me. And then this is the forward. So I'm not used to standing in one spot, so thank you for having me. I really appreciate the opportunity to speak to you all today, and I wanted to just go over a few things. I'm going to talk a little bit about angel investing, which I've been doing for about 10 years in Silicon Valley, and then a little bit also about Silicon Valley VC funds and how they work and think and operate. My first venture capital investment was 20 years ago, so I have a little bit of experience in this. So just quick background, I went to school, that's all that says. And then I also had some time in Spain, Mexico, and Chile. I'm more familiar with the rest of Latin America than Brazil, but I'm really excited to be able to learn more from you and be here as well. My background, I did enterprise sales. So I first job after MBA program was at Oracle. So I've spent a lot of time selling all in technology, software systems, big and small, multi-million-dollar software systems, and I've always been in technology. And then Inc. to me, that last one is company that most people that are born in the last 25 years have never heard of, but it was Google before Google. In 1999, they did 95% of all internet searches worldwide, $35 billion market cap, poof. Some of the things I've done in Latin America, so I spent a lot of time, mostly Chile, Colombia, I studied in Chile, obviously, Mexico, and I've done some speaking engagements. So I've got a pretty good sense for a Silicon Valley guy about Latin America and about how things work. As I mentioned before, I've done some investing. We have this philosophy in my family, which is before you drive the bus, you need to buy a ticket and sit on the bus and learn the route. So one of the ways that, the analogy I would use in investing is, a good family friend was DCM, which was a VC fund that was started in '97. So the first step I took towards investing was investing in a venture capital fund. You go to the annual meetings, learn a little bit about how they operate and how they think. So, and then also I was a member of an angel network in San Francisco for 4 years. And then Wasabi is a smaller fund that's done angel-based investing. So These are all investments that I've made that are sort of to learn the ropes and learn how investing works. PuenteLabs initiative is, the whole Puente means bridge in Spanish, and the whole idea is that we saw a bunch of people coming to Silicon Valley from Latin America that were not ready. They were going to see Sequoia or NEA, which are billion-dollar funds, and they were asking for $300,000. So Ariel Arieta from NXTP Labs, which is an incubator many of you may know, Alex Mendez, who's the chairman, who was the founder of Storm Ventures and had a multi-billion-dollar exit in the Valley, and Santi Subotovsky from Emergence, the four of us formed PuenteLabs. And then they were all Argentine, and it sounds like a bad joke, right? A gringo and three Argentines walk into a bar. So the first thing I did is I wanted to get some non-Argentines involved. So Antoine Colasso, who many of you may know from Valor Capital and Google, and then Alan Taylor, who runs Endeavor's network. In fact, they're doing an event here next week, I believe. And Ariel Polar, who's probably one of the most successful angel investors on the planet, originally from Venezuela. So all of us form the advisory committee, the selection committee for the companies. So it used to be 10 years ago, 15 years ago, this was the landscape. You started with friends and family, angel investors, and you go up the path. But what I've noticed is, in most of my talk's going to be about below the circle, down towards the right. So what I'm noticing, though, is there's a bit of blurring that's happening. So Peter Thiel can do a $3 million deal by himself, no problem. You see funds like Crisaka with lowercase tend to come down a little bit as well. So it's not so strict where these are separate stages. First you do family, then you do friends, then you do angel, then you do... There's a little bit of a blurring that's happening with these, and I just think that's an important trend to take note of. This slide takes a little bit of looking into, but the whole point of this is, if you look at this, the logos at the bottom are the companies, the year they went public, the left bar was the market cap, the first day of trading, and then the right bar is, as of last week, I took the market cap for these companies. So what you can see is, when Microsoft went public, there was an 800x return if you bought shares of that stock on the first day of the IPO. Then you go to Google, and it was a 21x return. LinkedIn, 5.5x. Facebook, for the first 18 months after it went public, had a lower valuation than when it went public. So you would have been better off buying the stock later on, and it took them a while to get back up above. So Uber, right now, the last funding round for Uber was at $62.5 billion. I don't know what that's going to go public at. I don't know what the long-term market cap value of that is. So the key point that I'm trying to make here is that you're all in a very good position as angel investors in early funds, because you're investing earlier on in the cycle where most of the value is captured. This is a slide, there's 3 circles, and this is 2013 to 2015. This is what happens every minute online. So you can see, YouTube videos, 3.3 million Facebook feed tweets every minute. So the reason I bring this slide up is we talk a lot in the Silicon Valley about exponential growth. So the amount of data that's created every month, or even if you take it on an annual basis, is more than all of the previous years combined. Our great-grandfathers and our grandfathers absorbed 1/1,000,000th of the information that we do on a daily and weekly basis. Where does this information all go? So I think the important thing is not the amount of information, but making sense from the information. We talk a lot about the signal and the noise. So I think what entrepreneurs are trying to do is figure out where those seams are and where those sweet spots are to do something at scale. So I just want to give a quick example. So this is the login page to Wells Fargo, which is a bank that I use in San Francisco. And you can see there's home loans, there's different categories of the bank that they do. Why am I showing you a website of a bank? It's boring, right? Well, these are the companies that are attacking each one of those distinct categories. So there are online lenders, there are credit card companies, there are simple. So the point of this slide is, and by the way, CB Insights is a great source of data if you want to capture all this information. A lot of it's available free. So, and here's another look at it broken up by category. The point I'm trying to make is Silicon Valley is very competitive. There's this image that you walk down a gold path and you pick dollar bills off of trees and failure's 100% accepted and everything's great. It's fierce. Competition is fierce. The good news is if you can break into the circle and the cycle, it is a meritocracy of ideas. But it's hard to do that, and you have to run fast. My estimation is companies in Silicon Valley run about 10 times the speed and the pace of companies in Latin America. So it behooves you as investors and also as entrepreneurs is to go there and see that and witness that. So this is what I'm an ex-sales guy, so I like funnels and pipelines, and this what this simply is I just want to show the volume and the pace that happens in a typical VC firm. So the top of the funnel, if you take an average VC firm, let's say it's a $400 million fund with about 4 partners, 6 partners, they get 8,000 submissions solicited in referral base on an annual basis. Each partner in the fund gets about 150 proposals a day. So the next phase is, okay, most of them they just dismiss. The second one is they take a look at it and they say, okay, this is interesting, it fits our profile. So there's about 300 or 400 of those. And then the next layer is, let's do actual due diligence on these companies. Let's call their customers, let's dig deep with the references and go through it. And then the last slide is depending upon the fund size, 1 to 12 investments per year. So you could have a case, there have been cases like 2008, 2009 where they did 1 deal. I think a deal a month is a pretty aggressive pace for a Silicon Valley VC. And then that number at the bottom is the number I use. I mean, the one thing that you have to understand is there's a binary outcome to any investing. So when I have a company that I've invested in as an angel, or I've sourced, or I've referred to a VC, and they invest in a Series A, I put the likelihood of success at 3%. That's after a Series A investment. If it's before that, I do 1%. I mean, the number's sort of meaningless, but it gives you a sense of how hard it is to get through this funnel, which is this slide. So 1,000 companies enter the slide or the top of the funnel, and that indicates that these are companies that have received seed or Series A funding. And if you go along the funnel, you guys can see the percentages, and you see not every company needs to go 5, 6 rounds, but some of the larger ones do. All this slide does is indicate the likelihood of success of a future round, and then on the bottom you can see the numbers that talk about the M&A and events that happen. Mike Maples used this slide last week. He's a big proponent of he used to call it thunder lizards, but power law. Essentially, for the math people in the audience, all it says is X being the return of your best investment in your portfolio will be greater than the sum of every other investment in that portfolio. Winner take all markets. There's one Facebook, everyone else is dead. There's one Twitter, which had some different times. There's one Google. So the idea here is that when Silicon Valley VCs put together a portfolio, they like to have 25 or 30 companies to diversify that risk. And the huge outside returns pay for all of the losers. I don't think you have to do this approach as an angel. And one of the benefits of being an angel is that you can sort of pick your strategy and your thesis, and there are ways to win without being involved in Facebook, I can assure you. So now I want to turn to Latin America. You'll notice that the bubble slid down a bit in the graph, and the reason for this is that I think there's a bit of a gap, a funding gap in Latin America between the accelerators and the VCs. So what ends up happening? You have what's called the Valley of Death, and this used to exist in the US about 8 years ago. Now, what all this graph signifies is that it's pretty easy to raise a couple $100,000 or even $1 million if you have a good company, a good track record, and a solid thesis. The problem is right at the point where you maybe pivot the company or you change the trajectory or change the focus, you run out of money. It's also fairly easy to raise $3, $5, $6 million in Latin America if you've got a good growth company. So what I like to do is address this, what I call the Valley of Death. The good news here is this was a report by New American that came out about 5 years ago, and this stat shocked me. So these are Fortune 500 companies in the United States. These are big, world-class global companies. I think the number is 23% of them were founded by immigrants. And it's not a small, and 41% were either an immigrant or the son or daughter of that immigrant. And they're not small companies in the tech world either. So if you look at some of the biggest technology exits that have happened in Silicon Valley, at least one of the members of the founding team was from each of these countries that you see listed. The other statistic that's interesting is 1/3 of all the IPOs from venture-backed companies between 2006 and 2012 were founded by an immigrant. And right now we're seeing about a third of the engineering CEOs in the Valley coming from India. Israel has a population of 8 million people. They've done over 70 IPOs on NASDAQ. What about Brazil? What about Latin America? That's the big question, is how do you replicate that success? So what does this mean? I think as an investor, I always ask these 4 questions. So we deal with a lot of Latin Americans or foreigners coming to Silicon Valley. You need to be really clear, because the way that I treat each of these companies that come to me and I talk to depends on the answer to this question. I mean, I've got my own biases, I've got my own thesis on this, but if it's a single country investment, i.e. only in Brazil, that's different. If it's a company that's going to do regional Latin America, there are funds like CASEC and Dalus and Monashis and Alta that address that need, and many others locally here as well. Like Umberto, who I met with yesterday at Performa, and there's some other ones that are addressing that. I want to spend a little bit of time on this slide because it's a little confusing, but essentially what you're looking at here are 3 fictional companies: the yellow line, the red line, and the blue line. The yellow line is a company, the bottom is years, the y-axis can be anything. I mean, it can be dollars raised, pre-money valuation, market, whatever you want to call it. They all work the same. So the yellow company is a company that came out of the gate, first let me back up. So as an investor, there's only 3 ways you make money. Either somebody buys the company, M&A, you do a secondary offering where you either sell your shares to an investor that wants to buy them, or an IPO. And I think an IPO on the NASDAQ's out of the question for a Brazil angel in a local market. You have to have 10 quarters of sequential growth and probably a $150 million quarter minimum to go public in these markets. So the yellow company is a company that you invest in, looks like things are going great, and then it just goes down to the tubes and it's done, flames burn. That's probably going to be 50% if you do your job well. The blue one is the one where it's the traditional J-curve or hockey stick, where they start to do well, they start to raise more money, they're growing, they're growing, they're growing. There's never a down round, and then they go to an exit event. Those are the unicorns, the 100x returns, the 50x returns. The red line is one which is a little bit more typical. Things are gray, things are choppy, things happen. So what happens is it starts off just like the other companies. It has good growth, good potential, gets angel investment, maybe raises a seed round, but it goes down. So maybe the seed round or the A was at a lower valuation than the previous round. That is death for an angel, because you are going to be recapped, your shares are going to be diminished, you might be total loss or partial loss. Then the company starts to take off and does really, really well. They raise a big Series B, and we're probably going to see this second dip with some of these unicorns that people have talked about. So maybe maybe it's an Uber or somebody else, and they're valued at 20 billion, and then the public markets, for whatever reason, don't want to accept that company. Then it dips down again. Those 2 dilution points are a total disaster for an angel investor. You don't have any power in those follow-on rounds, which is why I like to play in a little bit of a smaller space. In baseball, we have an analogy. You're either a home run hitter or a singles or a doubles hitter. I like the singles and the doubles. And if you look at these big companies in the Valley, most of their acquisitions are less than $30 million. Instagram, everyone hears about. Nest, everyone hears about. But if you go through and you look at the majority of them, they're buying smart teams. So what does that mean? As an angel, I want to make sure this is a good technical team. If things don't go well and the cap table is pretty reduced or pretty lean, maybe I could sell the company, or they could sell the company for 20 million or 10 million, make a 2x, a 3x, a 5x. So I think this, and the other point is, there's so much cash on balance sheets of corporations right now because of the low interest rates. There's a lot of borrowing that's happening. They have money to spend. I think you're going to see a lot more acquisitions in the next 3 years, at least from US corporate entities. So this is the angel investor part. I mean, it's interesting. You talk to an entrepreneur, and it's almost like a Bible comes down and it lands in their lap, and it says, "Thou shalt take the highest pre-money valuation possible." Right? It's just so ingrained in their heads. But I've had situations where entrepreneurs took a lower valuation with the right investors and had a higher outcome in a shorter time frame. And then on the other side this is particularly true in Latin America with family offices or with people that are used to private equity. They want control. They don't trust the entrepreneur. They're like, "Great, I'll give you $10 million, but I own 91% of the company, you work for me." So I think finding that right balance between these 2 groups is essential. Entrepreneurs need enough rope to hang themselves. They need enough rope to be able to either do or don't do what they said they're going to do. And investors need to not interfere with that process and look at 7-year financial projections like it's a private equity investment. So I think this balance is critical for angel investing, not just Latin America, but anywhere outside of the Valley. How do you appeal to, how am I doing on time? How do you guys appeal to an entrepreneur? I like to flip it and look the other way around. You can be horizontal or vertical, it doesn't matter, but you just need to have value add. So for example, along what I mean by horizontal is like you could be an expert in sales, you could be an expert in development, customer acquisition, SaaS, generalist type things, or you can be an expert in a vertical like pharmaceuticals or banking or finance. Either one is acceptable. You don't have to be all things to everyone, but there has to be a difference between you and the next person. So angel investors in the Valley typically invest 25 to 100K. The money doesn't matter. $25,000 to a $5 million raise is nothing. So what I've found is the entrepreneurs are looking for angels that add strategic value to the business. So I would never invest in a company as an angel unless I thought I could strategically add value to that business. So how do I do that? For me personally, as a sales guy, and I've got some investment experience in a pretty solid network, what I try to do is I help them with sales. So I've led sales meetings for companies until they hired the right person. I've interviewed those sales candidates for them. Typically, I like to work with engineers and people that are very skilled technically so that I can add a lot of the business value to it. So they don't know the questions to ask a salesperson in an interview. So I try to really add value. But the reality of it is, I think my greatest value add, and it took me a long time to figure this out, is I'm a psychiatrist. It's lonely being an entrepreneur. You can't say things to your employees for fear that you might scare them. You can't say things to your board because you're not sure it's the right board. Is it board worthy? So what I find is that, and you can talk to other entrepreneurs, but they're not in your business. So what I found is my place where I've sort of settled is that layer of, hey Mike, what do you think? I mean, and stuff happens. I mean, I've been through founder divorces, cheating, drug use, scandal. I mean, you name it, stuff happens. So I try to act as that sounding board of like, hey, this is important. You have a fiduciary responsibility to raise this. And what I found also is that, when we talk about segment diversification is, I put a cheetah up here because a cheetah sort of over-evolved. It's the fastest creature on Earth, but it became so fast at the expense of its strength. So cheetahs, I don't know if you're aware of this, they kill animals because they're quick, but then the hyenas come and the lions come and they eat their prey. They can't defend it. So you don't want to over-evolve, and they're not strong enough to bring prey up a tree like a cougar or others. You didn't think you'd get Animal Planet here, but here we go. But the whole point of this is I think you can specialize. So people talk about, so 1011 is a company that I've invested in as a VC fund. They do security and IT. The founder sold his company to Symantec, and all they do is IT and security. Ribbit Capital, Mickey is from Venezuela. He and Wences sold a company called Patagon. He became a VC. All they do is fintech. So every single Bitcoin company on planet Earth goes to Palo Alto to meet with Mickey. Emergence, they were the first enterprise SaaS VC. And then the bottom one I think is more germane and relevant to this audience, which is Fabrice Grinda and Alec Oxenford formed OLX. They were the founders of OLX, which was like a Craigslist internationally. So Fabrice he's French, and Alec is Argentine. Fabrice was so skilled at the numbers with these companies that were coming to him that had social platforms, Facebook-related businesses. He could tell you within a penny whether that entrepreneur knew what he was doing or not. So what happened over time is Facebook started calling him and saying, Fabrice, these companies you're sending our way are excellent. Do you have any more? So then what he started doing is creating syndicates on AngelList and his own. And now he works with Pedro Sorrentino, who I think a lot of you know at Funders Club. And they've just closed their last fund at $30 million of commitments, and they've done over 200 investments. All organic growth through just his slow building methodical process of investment. The advantage you also have here is I have a saying that I want to see the movie, I don't want to look at the photograph. So what happens in Silicon Valley is an entrepreneur sits across the table from a venture capital firm, they throw a bunch of pictures on the table, and then you have to make sense of these pictures of what is this going to be. Whereas in Latin America, you have the luxury that there's not as much competition from venture, so that you can actually, and angels, so that you can take a little bit of time to see the delta, the change. what's changed? And I heard someone ask that question yesterday to an entrepreneur, which was a very good question. What has changed from 3 months ago when we last met? You don't want to drag on too long, and you want to give quick no's if you know it's a no, but you have the advantage of seeing companies over time. So every single VC in Silicon Valley does some sort of version of this when they're looking at so I look at Silicon Valley VCs as a bit of, they're my customers. I have 2 customers. I have entrepreneurs and VCs. So unless there's an M&A event, which is fine, you want to figure out how Silicon Valley VCs are going to look at your company or your investment. So it's sort of, I don't want to productize it, but every Silicon Valley VC does some variation of the following. So is it a strategic fit? If I'm a fintech company and you're not a fintech investor and you're not a fintech company, it's a pass. It's got to fit. That's a yes or no. Then market size and the dynamics. What I'd call is, how big a market is it? If you're a $100 million fund and you're investing $5 million in a company and your expected return on that fund is $300 million, you're not going to do a deal that's $25 million. So you got to figure out the dynamics of the market that the entrepreneurs are going after. Product market fit, I think self-explanatory. Competitive landscape. What other, the biggest flaw I see in a lot of presentations from entrepreneurs is that they don't know their competition. You have to know your competition. And financial profile is just cash flow, those sort of metrics. And then team, to me, is the most important thing for any angel investment. At the early stage, most companies pivot, and you're betting on the jockey. So here's some of the exits that I've had as an angel. As I said, I've been doing it for 10 years. I've done about 30 total deals over time. But I want to point out, Index Tank was an Argentine who was living in the Valley who had a team in Argentina. Blink was a Hotel Tonight clone in Europe who was founded by a Spanish woman who then came to the Valley, sold it to Groupon. Pulpo Media was an American who did advertising in Latin America. So a full third of my exits came from founders in Latin America or from Europe. I can talk about violin memory. It was the one IPO that I've had, but it was not what you would think. I'll have that conversation another time, which is you're not out of the woods necessarily just because your firm that you invested in as an angel files to go public. A lot can happen. So these are 100% total write-offs. These are companies that went to zero. And I think, and some of them were pretty good. Like two of these were YC companies that I invested in 6 months before they got into Y Combinator. Some of them had offers for 25 million, and then 18 months later were worth zero. Some of them, the founders were just the wrong founders, and other ones just had they were trying to do too much on a technical level. There was too much technical debt. So let's talk about that. What are the mistakes that I made as an angel? If I could go back a decade and talk to myself and say, don't do these things, these are some of the things that I would do. So if you invest 100K in one company and 5K in another company, I'll tell you, the 5K company is going to be the one that's going to go well, and the 100K one is the one that won't. So you need to have a consistent dollar amount and a consistent strategy. I'm a curious person, so I've done everything from offshore wind, turbines to online advertising. I don't know that I would do that starting again. I would want to rely on my expertise and stay in a more narrow focus. Trusting my gut. I always make a joke that, so I do all of my payments out of an E-Trade account and I use bill pay. So I fill out, so I track it all and then I hit send. I always joke that you should have a fake practice way of writing your check. It could be handwritten, it could be online, whatever. Write the check, hand it over to the pretend entrepreneur, and just do a gut check. Because I tell you, like the ones where I send the check and you're like, oh, they never work. The ones where you're like, yeah, that was a good thing to do. So you could do your own mental check, you could do whatever, but for me, I've always like, there should be a bill pay, are you stupid feature. Like, don't do that. Are you sure? Are you double sure? And then I talked about the jockey before. And then the other thing that happens, and you just have to take this with a grain of salt because it happens. So I'm usually one of the first 20 people to meet a company. I get in early. So I see the ugly, and I help sometimes shape it. So I saw one company that will go unmentioned, and it was terrible. I literally said after the presentation, that's the worst presentation I've ever seen. Here's what's wrong with it. And I gave like a laundry list, and the woman just looked at me, she smiled, she said, yeah, you're right. Well, thank you so much. Can we stay in touch? I'm like, great. So then we didn't stay in touch, my bad. A year later, she comes to me and she goes, Mike, you never guess what happened. I'm like, what? Mark Benioff, CEO of Salesforce, just led my round. He just put $3.5 million in the company. He loves it. We're doing stuff with Salesforce. And I just looked at her, I was like, well, why did you call me? She's like, no, but you were so helpful. All the stuff that you said, I changed. I redid the whole presentation. We changed our revenue model. We did all, that was so, thank you. And I'm like, oh, that one you can't get back. But it's going to happen. Everyone's got a story like that in the Valley, and some of them are even bigger. So these are some of the investments. Actually, Centro, some of you may know, that's my only active investment in Brazil. Valor Capital is one of the investors in that company, and you'll hear some news about that one. They do, it's Uber for trucks, so they do a lot of loading of loads on trucks for independent truckers within Brazil. And then some of these other ones, I mean, just to give you just a flavor, like some of the, Corner Shop is the other one that's a talented Chilean entrepreneur. They're in Chile and Mexico, and that's Instacart. It's a clone, which is not typically what I do, but I really, really like that team. Some other are in retail and cloud-based. You can sort of see that I've got a preference for enterprise-type companies, because that's what I know. And then the other thing that's important is participation. I like to know where you're going. I mean, I would never get in a car and drive somewhere unless it's just a leisurely drive. You gotta know where you're going. So for me, what that means in this context is I want to know what investors would be interested in this company, and maybe even do the round with them. The kinds of deals that I've seen that have worked the best are sub $2 million, and these are Silicon Valley numbers, a sub $2 million raise with one major lead who's a board member, and maybe $1 million or $1.5 million of VC funding, micro VC or a smaller tranche, and then 6 to 8 angel investors that all have value add. That to me is the best deal, because then there's enough money for the company to get to the next proof point. And I know Paul earlier talked about chips and manufacturing and all that. That's not my world. I don't do anything in hardware. It's all software, and it's all things on Amazon or Rackspace, or they can be dialed up or down. So the idea is, if the company does really, really well, you turn it up and you pay, $10,000, $30,000, $50,000 a month at Amazon. If it's not working, you turn it down and you figure it out fast. So my paradigm is one of software and internet capabilities. I just don't understand. I mean, Fitbit was a great IPO. I use one, but I just don't understand hardware. The other thing too is I found that on the left side here, I've been lucky in that you have to do a lot of work up front. You don't just show up and say, unless you're a big name investor that's really well known, and I work hard to get into deals. I do probably 80% of my work up front, and I get referrals from people that I've helped 4 years ago, 5 years ago, just because I wanted to help. And they'll come back to me and I'll say, how do you even know who I am? It's like, oh, so-and-so referred me to you, said you were really helpful to him for whatever. So you got to realize, in order to have longevity in this, you need to do a lot of what we call good karma type meetings. I meet with probably 15 entrepreneurs from Latin America every single week in Silicon Valley. The likelihood of me investing in any of them is low, but I do it because I just want it's part of its branding, but part of it's also, that's just the way the Valley is. People are pretty open and willing to work with one another. And then the same thing goes with the VCs. So I've been spending a little bit more time with this aspect in Silicon Valley, getting to know some of the VCs, and so they know that, you saw that funnel earlier. If they know you and they trust you, then they'll look at your deals. If you give them crap, they won't ever talk to you again. So you got to be really selective on that front. And then I think it's helpful. I like the quote, "Before you walk in another man's shoes, you must first take off your own." I always like to flip it and think from the other perspective. So you may have heard the comment, the entrepreneur is the pig at breakfast, the investor's the chicken. Chickens can lay eggs and lay eggs and lay eggs. It doesn't hurt them, but you know what? That pig has one breakfast. So remember that. I think they're always looking for smart money, and then if you do it, I've always said the world-class CEO does 3 things, right? They don't run out of money for the company. They hire people that are smarter than them, and then they get out of the way. And then they create the vision and the culture for the company. If you do those 3 things, you'll be a world-class CEO, and you'll sleep like a baby. And what I mean by that is you'll sleep for an hour, cry for an hour, sleep for an hour, cry for an hour. In summation, some of my learnings that I've had, and I've talked a lot about this, but I would say, start slow, do one deal and just wait 3 months. Do another deal and wait 3 months, and you'll start to see but pay attention to what you're doing. Like if you recognize, like in my case, I've recognized that I tend to work with very smart technical founders that don't know anything about business. That fits me. But you'll figure out over time. So don't rush into it. Even if you have the money, even if you have $20 million in your pocket, we can talk later, but even if you do, just go slow and just take your time. A lot of this is learning about yourself and learning about your own, shortfalls and shortcomings. And then just be consistent. I like Charlie Munger more than Warren Buffett. I may be one of the few, but I think he's Warren Buffett's partner. And this quote inspires me because Charlie is just this folksy guy. And for those that don't know, he was Warren Buffett's partner. And Warren attributes a lot of his success with Berkshire to Charlie. He lives in LA. He was a lawyer, very methodical. He's got glasses that are that thick. And the point of this quote is, you don't have to be the smartest person in the room. You don't have to prove to everyone that you're the smartest person in the room, even if you are. I think just having a framework and a way of thinking about things, over time, I feel like the luckiest guy in the world because I get to talk to people that are way smarter than I am, and they all want to change the world, and I just get to sit in this seat. It's an amazing, it's not easy. I don't want to give you those, some people, yeah, they invest in Instagram and Facebook and it changes their lives forever, but you got to be in it for reasons other than money and return, because you could just invest in the market or some other things, your own businesses. But I think if done right and with the right context, it can be one of the most rewarding things in the world. And that concludes my presentation. So if there are any questions, we're happy to take them. Don't be shy. Everyone's always shy. Nothing. Did you understand my English?
Hello, Mike. First of all, thank you very much for your presentation. My name is Ricardo Politi. I have a platform such as AngelList for Brazil, and I would like to know how does AngelList and Funders Club, for example, change the landscape of syndicates and angel investing in Silicon Valley in the past 5 years?
If you ask the venture community in the private equity world, they'll tell you no, zero, but they're wrong. It clearly, and I think Paul mentioned this earlier, there's the Jobs Act and there's some things that are happening. I'm not a big fan of government mandated changes for investment. I think there's some problems with that. But I think what Funders Club has done is, and also I would include Indiegogo and some of these crowdfunding platforms if you have a hardware product, because what those do is pre-fund inventory. And so I think what it's doing is, well, let me just put it this way. I think from an absolute return perspective, as an investor, it can be challenging unless you're the one with the carry leading the fund. But what it is doing, if done properly, is it's opening up this whole market so that it's almost like a mutual fund or a REIT or an ETF or an ETN in the markets. That's what's going to be happening. I suspect in 15, 20 years, these will be viewed the same way. And I think the genius of what Naval did in Nivi with AngelList is they collected some of the most high net worth individuals on planet Earth, and they got them all together on an online platform and sharing. So I think it's here to stay. I think there's some kinks that need to be worked out around that, but I think they're very promising. I'm happy to talk to you as well about that, but I think it's a good thing for the industry. But one thing for entrepreneurs, and I usually talk to entrepreneurs more than investors, but for entrepreneurs, it's one path of fundraising, it's not the path. So what I would recommend is, if you're going to raise $500,000, have $300,000 closed with your investors, and maybe use that as a second avenue to get smart money in the deal that you don't know. So that's where I think there's a huge value add for that, is you have investors you didn't know, they like what you're doing, they come out, and I look at AngelList. The downside of it is, as an entrepreneur, you have to assume that whatever you put up there, everyone in the world sees. So that you don't put up your private information on there because your competitors will have it. I wish it wasn't that way, but it is.
That was a great presentation. I'm Fernando from a healthcare accelerator in Brazil. And I would like to know, what do you think is necessary for us to have more connections, not only with Silicon Valley, but with investors in Europe, in the angel phase, and then in the VC phase? Because what we see from day to day, it's very hard to access Silicon Valley. So can you tell a little bit about your experience about making investing in Latin America?
The group from Globant, who I know, one of the founders of Globant calls me Gringo Loco. So there aren't a lot of people that are willing to come down here and do that. I mean, I know here you have eVentures and Redpoint and some others. You know, I mean, the blunt short answer to that question is a huge success story, period. You know, Bootstrap started there and that didn't quite work out. You just need success stories. So it could be here, it could be there, it could be cross-border, but you know, Mercado Libre got a lot of people's attention. You know, and it took 14 years in Argentina for that ecosystem to develop, but it all happened. You know, there are 5 companies and 12, they're guys unfortunately, but 12 guys that you could trace a lot of the growth in that market. You just need success. And unfortunately, you know, there's no shortcut to that.
Hi. I would like to know a little bit about the regular size of an angel investment in the US and more or less the dilution that you work with.
Yeah, so and a lot of it depends on the format, if it's a convertible note or a price round or common or preferred share. There's a lot of variation, but I would say maybe we do that instead of the bill pay feature. That would be good. So I think it varies by investors, but I would say 10K is probably minimum. 25K is generally, you know, the way it's set. Most of them. 50K is common. 100K and more tend to be, you know, pretty bigger names per individual. And I would say the rounds themselves, usually 200K doesn't make any sense. It's got to be somewhere 500K to 700K, depending upon the company and what they're doing. So, you know, it just depends, I think. And then dilution, you know, it just depends. I mean, maybe we can talk offline about that, but a general rule of thumb is I, as an angel, have always tried to get 1% of the company in the round I do, and that's because I'm early. And that typically gets diluted by, or you could say the same for advisor shares. Post Series A, it's usually 1/3 of a point, and then Series B, it goes down from there, without that red line that I showed you before. So assuming that everything goes up and to the right. So I think most models of, you know, $1 million, the total angel investments usually used to be 10 or 12% ownership. And then the Series A investor, we're usually looking for between 20 and 30%. And then the Series B investor is usually 20 to 33%. It's changed. So some of that's blurred a little bit, but that'll give you an idea. And then I think the model that I did is that IPO, if all things go right, that 10% is probably worth 3%. And just at one extreme, if you look at a $100,000 investment in Google at the first check-in, if you held throughout and didn't sell throughout to today, would be about 1.5 to 1.7 billion. That's extreme. More likely, you know, you're owning sub 1% unless you have a fund.
Actually, I have 2 questions. First, what's the average return that you expect from your angel investments? And second, how you deal with the valuation when you're investing in a very early stage startup. You don't have the cash flows, hard to do the multiples. So how do you approach valuation of this?
Yeah. So I think, let's deal with valuation first. So valuation is all over the map. I mean, you have to just sort of know your markets and know them. So Y Combinator is sort of the gold standard. Post Y Combinator demo day participants, and there's about 200 now, used to be 10 to 12 million pre-money, which is pretty high. It's gone down a little bit. So I would say, you know, you have to have your thesis. So in Latin America, it can be a lot less than that. Like I've done deals down here for $1 million or $1.5 million or $2 million. You just have to figure out what it is for you and what you think the growth prospects are. I think traditional metrics for valuing companies like net present value, cash flow, those work for restaurants and operating concerns. They don't work for startups. So the answer is whatever they get, right? Whatever it is. And how do I deal with dilution? I will not invest in a company without a cap on the note. My preference is not to do convertible notes at all. My preference is to do a price round of at least $1.5 million to $2 million that gets you 1.5 years, 18 months out. But if I do a convertible note, which is more common these days, I would never do one without a cap. And capping it caps the value, which is why I would prefer to do a price round, because if you set a cap, what you're essentially doing is setting a valuation for the business anyway, but it's just debt on the balance sheet as opposed to shares of stock. So we can get into that conversation, but I think you have to have your own view of what that is. Some people will say, chase the big ones, you know, do Uber if you did Uber at 100 million, you made a lot of money. But you have to have your own strategy. For me personally, I get a little bit squirmy in the valley anything over 5 to 7 million. And part of the way that I mitigate that is I work with these companies early so that I get brought in usually at the valuation that's set by the incubator or earlier. And then I try to add value throughout. So I think that's...
Yeah, thank you very much.
Thanks everyone, I appreciate it.
I really like the presentation, but the one thing that I will never forget is about the baby sleep. It was really, really nice. Thank you very much for sharing your thoughts with us. Mike is a very good connection for all people that are thinking about internationalizing. He knows Latin America very well and also Silicon Valley. So to understand how a guy from Silicon Valley understands our world is really, really important for us. Because remember, we are not here to build just Brazilian companies that go great here, very nice, but we are going to do companies that go global from day one. This is what I learned from in Israel, right? Boaz is here somewhere. And this is what we learned, and this is really important.